All right, welcome everybody to today's webinar on interactive contribution strategies in a self-managed superannuation fund. So what the purpose of today's session really is about is clearly just a bit about identifying various strategies that are available, not only in self-managed super funds, but certainly when you start to put various strategies together in the combinations like I've done today, then clearly the SMSF is the vehicle that makes this all possible a lot easier than any APRA fund. And of course, with a self-managed super fund, some of these strategies are really only available within that structure as well, based on the timing requirements and things associated with it. So let's jump straight into it. The disclaimer, as always, everything's as it should be, as at today's date, or as at yesterday's date, where I finished putting the presentation together. Hopefully, we're not going to see any changes of the law in the short term. Of course, being an election year, we don't know what's ahead of us with regards to superannuation. We always hear no changes to super, and then of course things change. Often minor changes, but those minor changes can mean a little bit from an SMSF point of view, particularly from a planning point of view with regards to contributions and issues, just minor issues like indexation and elements like that, which ultimately change the trajectory of what we're trying to do with our clients. So what we want to do in this session is identify contribution strategies and whether they're viable within a self-managed superannuation funds, the type of strategies that are suited to types of people. So really what I'm trying to do there is identify from a matrix point of view, who we should be looking at for various styles of contribution strategies, particularly as clients are approaching their retirement age, and also then what we need to do with regards to qualify for the various strategies. So it's not just about making contributions, it's about what other additional requirements are there for us to ensure that we can satisfy all of our contribution needs. And then, of course, what happens if we get it wrong? And the reality of getting it wrong is it's certainly not as terrible as it was in the post 2007 introduction of contribution cap world. We probably had to suffer through that for 4 to 5 years before we saw some significant changes. But over the last 5+ years, the excess contribution rules, while still annoying, are certainly not from a tax point of view as problematic as they definitely once were. So where do I start? I always start with the acceptance rules, because what we have to have comfort with is these rules have changed a bit, and they changed quite rapidly from about 2021 through to 2023. Not only with changes to things such as downsizer, but movement of the work test requirements, and particularly with the capacity to contribute up to 75. So that requirement that came in, giving us the ability to make contributions up to 75, did away with things such as the fund capped contribution rules, which meant that previously we certainly had greater capacity pre-age 75 to refund certain contributions when they were made in error. Those rules are effectively gone, and ultimately prior to age 75, there's very little recourse for a self-managed super fund that gets things wrong, other than to go through the excess contribution process. And I think it's worthwhile, obviously, always noting that to identify to clients, look, if you've got a problem, if you make contributions, if the contributions are made in error, there is a process. It's going to take time because we have to go through the ATO, but recognise that the solution is not to pull money out of the fund and try and rectify it that way. So we'll work through some of those key issues. But of course, the main one is that when we're talking about age 75, we're actually referencing that we can make contributions up to 28 days following the end of the month in which we turn 75. So from a non-concessional contribution point of view, we extend that time period just beyond the month in which we turn 75. And of course, the other key thing that occurred with the changes from 2022 was the removal of the work test from the SIS regulations, and moving those requirements into the age-based contribution rule requirements around personal deductible contributions, which ultimately means, and I'll confirm this again throughout the presentation, it ultimately means that SMSF trustees are no longer responsible for determining whether someone has or has not satisfied the work requirement, the only obligation on the SMSF trustee is to appreciate whether the person is indeed under or over 75 from a contribution from a pure acceptance point of view. There are obviously other sorts of rules that we need to be mindful of. The other key thing before we start any sort of strategic sort of conversation around contributions is to appreciate the various indexation or increments that certain contribution limits have gone through, not only last year, because obviously right now we're in that final quarter we've just started the final quarter of the 24-25 year, but we're contemplating what contributions to make for 24-25. But in addition, we're also contemplating what contributions may we be entitled to make from 25-26. So having that appreciation that the general transfer balance cap will increase from the 1st of July and what that means, particularly in reference to non-concessional contributions. But no movement in the concessional cap or the non-concessional cap. Those that are looking for CGT contributions obviously will have an increase from the 1st of July. Super guarantee goes up, and of course super guarantee maximises then at 12%. So we've had this fractional movement for SG over the last few years, and that's really had impact on things like the maximum contribution base, which you can see is going down next year. And so with SG then sort of plateauing out now at 12%, we can really start to plan knowing that there's no more movement with regards to that. And so when we're contemplating personal deductible contributions or salary sacrifice arrangements, we're not having to factor in, like, are we at 11%, 11.5, what's the number, is it going up next year? We're fixing on that 12%. And yeah, just to touch quickly on that maximum contribution base, clearly you can see it's gone from 65,000 this current year to 62.5 next year, and that is ultimately an implication of the caps not moving, but the SG rate going up. And with the SG rate going up, it means the compulsion to pay super guarantee has to reduce the income in which it's compulsory on, to ensure that the SG in itself does not result in somebody exceeding their concessional contribution cap. So from an indexation point of view, probably the most critical piece is then the link with the non-concessional contributions and the difference that makes with our total superannuation balance. So right now we're looking backwards, okay? So we're looking back to 30 June 2024 with a $1.9 million general transfer balance cap, which gives us our various thresholds, whether we can make a 1 year, 2 year, 3 year non-concessional amount or no non-concessional. And of course, then from a planning point of view, moving forward, we add $100,000 to that, and our numbers go up from, say, 1.78 to 1.88, 1.766 to 76, and less than that 1.66 goes up to less than 1.76 million. So that obviously provides us with some opportunities, and probably the two significant opportunities that come about with regards to the different timing of indexing the contribution cap and indexing the general transfer balance cap means that particularly in this year, we're in a situation where, for example, somebody who had triggered their bring forward in the preceding couple of years is locked in, is locked into the previous cap, so they did not get the indexation that other people got at the 1st of July 2024. So that's always a key one to be mindful of. Which cap are you locked into? And the other one is with the indexation of the general transfer balance cap moving forward, is do we have a capacity now to finalise or finish off what we've triggered in a previous bring forward position, subject to the fact that our general transfer balance cap is going to go up. So the two examples there really just highlight the difference of one, not indexing the cap, as in not getting the uplift piece whilst we're in a bring forward period, but two, being able to execute on the entirety of a bring forward amount based on the general transfer balance cap indexing as at the 30th of June. So a couple of nuances there to be mindful of with regards to our clients. And of course, just on that, and those that joined last month will know that I'm sort of forecasting that the concessional contribution cap, which ultimately means a non-concessional cap, are likely to index as at 1 July 2026, based on the current average weekly ordinary times earnings figures. If indexation sort of tracks in the same direction as it has for the last 3 years, then we would expect that the transfer balance cap won't index again immediately. So there'll be another sort of 2 years until that indexes, but the concessional cap and the non-concessional cap will go up from the 1st of July 2026. But of course, that's subject to elections and government promises and of course, wages continuing to theoretically increase there. So a number of things to get through before we get to that point, but really strategically just to highlight that it may actually happen. So from a contribution strategy point of view, and those of you that have seen me present on contributions, this will be a very familiar slide to you. It's really what I identify as the core strategies, and then less standard, but still relatively core in some instances, strategies that we see inside the realms of self-managed superannuation funds. From my very first day in this industry, recontribution strategies have obviously always been the number one ticket item when it comes to contributions, and I certainly don't see that changing in the short term. Whether it ever changes, who knows? But certainly it's a great opportunity, particularly with our contribution window extending to 75 and our condition of release remaining at at the latest 65. It gives that 10-year potential recontribution strategy, whether it be personal recontribution strategies to look at tax-free taxable stuff, changes there, or whether it looks at rebalancing and spouse contributions, so moving money from one member to the other. And of course, that spouse recontribution and rebalancing piece is often discussed and has often been discussed in recent times in regards to Div 296, which of course, fingers crossed, in its current iteration, we all hope that we've seen the end of it. Only time will tell, post-election time, subject to who gets into government and what sort of appetite they have for it. We know that the current government, if they get elected back in, that it's still within their budget papers, so it's still within their numbers to raise this revenue. So we at the very least, we think there's still an argument between the houses as to whether this legislation passes in some way, shape or form post a federal election. But of course, one of the key things is the likelihood of it actually being able to pass and be introduced from the 1st of July 2025 is clearly diminishing the longer we go. So multiple contribution strategies. We're going to focus on a few of these today, because what we're going to do is say, okay, well, how do we identify some of these strategies and how do we build them and work on them, or work on them and build them together for the benefit of clients. So we'll focus primarily today's session on some of the strategies that sit there with the concessional contributions, but we will throw in a couple of the less standard strategies as well when discussing what opportunities are available for clients. One of the key things about all of these strategies, and one of the elements that I try to highlight whenever I'm talking about contribution strategies is we often talk about, and I showed you the slide before, which said all contributions are ultimately age-based. And so therefore all contribution strategies are somewhat conditional. But when we sort of dig deeper and try to find out, well, how many of those existing strategies that I've listed have some form of condition linked to them, the answer is that they all do. So whether if we're talking about recontribution strategy, not only is it age-based, but it's also total super balance based. That's the same with the bring forward amount. Salary sacrifice, do you have an arrangement in place? So the condition is that you've obviously got to put that arrangement in place with your employer to be able to make those salary sacrifice contributions personal deductible, and your notice requirements. So the list goes on to suggest that there is no strategy that is in existence that doesn't have some form of condition attached to it. Even Super Guarantee, it's got an employment requirement there and then it also has conditions around maximum contribution base, but also multiple employers and the ability to opt out of super guarantee. So it's just understanding that there are requirements in place whenever we're looking at these strategies and how that might impact our client. And for some of those conditions, it's appreciating what notice requirements there are or what elections must occur with the contribution and the timing of those notice requirements. So again, whether or not it's the requirement to make a notice of intention or lodge a notice of intention to claim a tax deduction from a personal deductibility point, understanding that there is a timing requirement there where you're lodging your tax return or end of the following financial year if you lodge your return late. But in addition to that, there's also the considerations, well, are you actually starting an income stream? Because the contribution, if it's part of that income stream, and the short answer is it will be if it's made before it, have you put your notice of intention in prior to the commencement of that pension? And so next month we're going to do a bit of an interview checklist. So I'll touch a little bit more on the notice of intention requirements when we talk about the 30 June, 1 July checklist requirements in our next webinar. But you can see there, lots of the strategies have some form of election requirement. They then have a timing element of when the notice needs to be lodged and who needs to receive it. So whether you're actually making that request via the ATO or whether you're making it to the fund. And so trustees need to understand that from an acceptance point of view. Members need to know that from a making point of view. But I've just finished a roadshow where we talked through a lot of various contribution strategies, and we had auditors in the audience who talked about the receipt of a CGT. So someone had a small CGT concession contribution, and they didn't put their notice in prior to the timing of the contribution, so it wasn't made before the contribution. So in essence, that's a non-concessional contribution, and given that the CGT amounts are normally well and truly above the non-concessional cap, that's going to create a problem for that fund, which can only be solved through the excess non-concessional contribution process. So, appreciating that these requirements exist, but also appreciation what the ramifications are of getting it wrong. And when we talk about notice of intention to claim a tax deduction as one example, appreciating that the Commissioner doesn't have any capacity to accept them outside the boundaries of the legislation. So good to have all that information, at your fingertips. But of course, from a application point of view, one of the things that we can, to an extent, control. Obviously, once a fund gets to a certain size, it's more difficult to control it. But one thing we can control is when we're talking about various strategies to clients, we can tailor what we're talking about based on having an appreciation for that individual's total superannuation balance. So knowing what their balance is at the previous 30 June is critical to be able to say, okay, well, let's recommend using the unused carry forward concessional strategy because you've got a total super balance less than $500,000. Somebody that's got more than $1.9 million at the moment saying, well, okay, look, you can't make non-concessional contributions, or more to the point, your cap is zero. And so if you do make a contribution, then it's going to result in a problem for you. So having an appreciation that total super balance dictates so much of what is available to us from a contribution point of view. And then to go one step further, what I tend to look for is, okay, well, what is the circumstances of the individual? So before with total super balance, we're looking at the super fund position. So what is the balance of the individual? Basing on the SIS requirements, we're looking at what is the age position of the individual. So what is the age? What is the balance? And then what are our notice requirements? But then what is the makeup of the individual and their family as such? Because are certain contribution strategies worth contemplating for certain circumstances and certain family dynamics? And you take the situation of somebody who's single with no dependents. Well, we know we're taking anything to do with recontributions for spouses and spouse contribution splitting. We're taking that off the table, right? But maybe we're also taking recontributions off, because at age 60, if everything's going to be non-assessable, non-exempt income, is there really a need for them to manipulate the taxable and tax-free component of their benefits? Now, a counter argument to that will be, how long will that legislation last for? It came in 2007, but is it good policy, right? We all think it's good policy if we can receive superannuation benefits tax-free, but will a government at any point in time have a large enough mandate to go, actually, we're losing out because of this tax-free and taxable amount. We're losing out because of exempt current pension income. So we might actually look to change some of these rules around that in a super environment. Not suggesting that will happen, but suggesting that anything goes in as far as superannuation is concerned. And so maybe in that single non-dependent person, maybe the recontribution strategy is worthwhile whilst it's currently available to them. But then we look at, say, the nuclear family, and we look at all strategies potentially being available, because, first spouse, only spouse, such situation. So the whole concept of rebalancing there, you might want to make child contributions into the fund. If there's happy families and the children join up and become members of the superannuation fund themselves, and then you reference that against a blended family where such things as contribution splitting and spouse contributions, and then of course spouse recontributions, may not be as appropriate, because we're looking at superannuation as an estate planning vehicle as well, or we're looking at one of the end results being that it's going to be a distribution of wealth when a member passes away. And if that money has been moved from one person's account to a second spouse's account, well, then that money is no longer at the availability of the estate of the deceased to be able to distribute to children from a first relationship. So in essence, are we actually taking certain strategies off the table when we deal with a blended family? Now, my job here is not to tell you one way or the other. It's really just to say, these are the things that we need to consider when looking at these various strategic opportunities for our clients. So what we're going to focus on today is really working through personal contributions, and largely personal deductible contributions based on circumstances and fund circumstances, and having an appreciation that when we look at the quarterly ATO statistics that come out, and we look at fund balances and member balances, and they work on averages and median values, we should get, or do get, an appreciation that many self-managed super fund members will have a total superannuation balance of less than $500,000, right? Particularly those that are in the contribution stages and the early contribution stages. So it means that we're tailoring strategies around the concessional contribution cap, right? So and ultimately, a lot of these people will have the capacity to make non-concessional contributions. However, in saying that, a lot of them won't have the liquidity to make non-concessional contributions. So they might have access to money to be able to make concessional. So we look at those strategies first, and then we can tailor and bring in the non-concessional contribution strategies when we have some form of windfall or whatever it might be, to be able to give us that ability to make contributions. So the first one I want to touch on is the carrying forward the unused concessional contribution piece. Now, as a side note, and I referenced it, I think, in one of our previous webinars, there was a court case recently about the mandatory nature of this cap as such, and utilising the language that had been used in the ATO's website. But I want to make it clear that if you've got less than $500,000 and you don't use the full concessional contribution cap each year, then your concessional cap is not $30,000, right? Your concessional cap, if your balance is less than $500,000, is whatever you haven't used for the previous 5 years on top of the current year's cap. So that's a mandate that applies to everybody. Whether you choose to use it or not is secondary, but from a primary point of view, your cap, which is why MyGov and that information is so important, your cap is based on what has not been used in the previous years and what the current year's cap is on that 5-year rolling basis. So it's important. And so what I always say to clients now is, okay, the 18-19 contributions, they're gone because a 5-year rolling period, they disappeared last year. The 19-21, so if somebody wants to make a contribution in addition to the 30,000 this year, what have they got available from 19-20, right? So from that 19-20, they'll use that on that first out basis after the current year. So the unused concessional carry forward is a really positive strategy to be able to use for a very significant portion of our superannuation members, right, who inevitably have income and tax liabilities, right? And this is and I'm going to touch on this a little bit in one of my final strategies when I talk about transition to retirement income stream. Of course, that's only applicable from age 60, but the whole sort of piece around say salary sacrifice and contributing to super, it's going to become certainly a lot more prevalent from a conversation piece, you know, as we move to lower marginal tax rates outside of super. So we already know that we've currently got a 16% tax rate. There's already a proposal for 15% from 1 July 2026 and then 14% from 1 July 2027. So, you know, there'll be certain circumstances where it won't make sense for people to utilize salary sacrifice, but obviously then the decision becomes, well, do we want that money inside or outside of super? So the carry forward concessional, let's have a look at an example. And we're going to build on this example of Helen through today's session. So I'm ultimately going to focus on one couple and look at how they can potentially use various superannuation strategies to maximize their tax benefit. So Helen earns $100,000. I kept things pretty simple because that's how I like to operate from an example and maths point of view. So $100,000 gets her super guarantee amounts each year, and that's all she's been receiving up until this point. So we look at it and we notice that Helen has this carry forward amount that carries on each year through the process, ultimately resulting in her carry forward amount being $82,000 in this current year. So we then add that to the $30,000 cap to give her a concessional contribution cap of $112,000. So in theory, on MyGov, her concessional cap is going to be listed as $112,000. Now that's all based on the fact that at 30 June 2024, her total super balance was $495,000. So we obviously have to always move back a year to see what the total super balance was. You'll see there that at 30th of June 2020, the total super balance was $510,000. So it meant that in that year, Helen would not have been able to use the contributions from 18-19 and the 19-20 year because she was above that $500,000 cap. It doesn't mean that the calculation doesn't occur in the background, okay? So the tracking of unused amounts is something that is provided by the tax office. Just your availability to it is going to be linked to the total super balance. And so one thing that I tried to make clear in this recent roadshow that I did when talking about this sort of stuff, people often have questions about the information provided on MyGov and through the various superannuation platforms. And I guess what I try to do there is to a degree, I try to defend the ATO's position and say that the ATO very much are reporting what we are providing to them. So if we are reporting garbage in via the annual returns, then they're going to report garbage back out to us. So we need to make sure that what we're providing from a total super balance point of view, what super fund administrators are providing from a contribution point of view matches what the clients are reporting. And so everything can be reported accurately via the tax office system so that we can then rely on that information when making contributions or recommending contribution strategies to our clients. So when we look at this situation here, Helen, her maximum cap space is $112,000. However, we know that her super guarantee amount is going to be $11,500, which means that she's got the capacity to make a personal deductible contribution of $100,000 $100,500, right? So that is something that that is available to Helen. Now, of course, right now, and until we move into a world of payday super as such, which we're assuming is from 2026, that if we're looking at making personal deductible contributions, we really need to have that appreciation for when our employer contributions have hit the superannuation fund, because obviously if it's $11,500 for this year, right now that that June or that final June quarter contribution doesn't have to go in until July, and so we might actually have the end of the 23-24 contribution to factor in, not the full amount from this year. But I've worked on the concept that all the contributions are made in the year that they effectively are attributable to. So in this instance, Helen could make a personal deduction, personal deductible contribution of, as I said, $100,000, which is great because she's got the sale of an investment property, but clearly with a $100,000 income, she could, if she chose to, if she had the liquidity to, she could write off ultimately into her entire personal tax liability. So that's our first strategy that we'd be using, is how to go beyond that $30,000. The second piece is there any value in us going over and above the current year levels to bring forward any portion of next year's amount? And so where self-managed super funds clearly are more beneficial than APRA funds is the use of these contribution reserves. And that's because we still operate largely under, or not largely, we still operate under the SIS requirement where all contributions must be allocated within 28 days following the end of the month in which they received. So therefore, we have the capacity to allocate contributions made in June in July, which will mean they'll count towards the following year's cap. Now, appreciating that from a practical point of view, the way contribution reserving works is that the contribution is accounted for in the year of receipt. So the tax is payable in the year of receipt. It is claimed from a deductibility point of view in the year of receipt. It is just that there is a process that we go through via the request to adjust the concessional contributions with the ATO, where we can have the amount moved for cap purposes into the next year. So there's paperwork requirements there where ultimately you can put in place minutes to say that the contribution will be received in June, and is subsequently held on reserve, and then more minutes to subsequently allocate it between the 1st and 28th of July. So normally a contribution would work like this. We utilize our 24-25 contribution caps. We put in our additional $30,000 if we've got that full cap space available in the following year. In June, normally that would result in an excess contribution, but by using a reserve, we would pay that amount in June, allocate it to July, therefore resulting in no excess contributions. However, of course, the caveat to this is that it's not suitable for particularly super guarantee employees who have large super guarantee amounts going in. We know in Helen's situation here that Helen is putting in that $11,000, so there is cap space, all right? So we can bring forward part of next year's cap space to be able to maximize a deduction in 1 year. So you're ultimately going to be looking at this strategy, this reserving strategy, where you've got one-off large tax events. It might be trust distribution, might be sale of investment property, might be, as it is in this case, might be transferring listed securities into the fund and raising CGT there. So it could also be that it's your final year of earning, and you're not going to be working from an SG point of view next year, and so you're wanting to maximize the deduction into super this year. So when we then apply that same amount, the reserving amount, onto our unused concessional contribution requirements, well then we've got our $100,500 that we had before, but we've then also got a further $18,000 that we can bring forward from the previous years, and that is simply the 30,000 cap minus the 12,000 SG requirement. So we're making an allowance for that SG amount, and it means that the total personal deductible contribution that Helen can make this year is $118,500. Now, again, I'm putting the maximum limits on these contributions. Helen might not need to do all that, so she might not go down that path, but it's showing that she can make that amount and claim the deduction in the current financial year for that and not have any contribution cap issues. Of course, she's going to blow her $500,000 out of the park as far as her balance is concerned. So there's not going to be any capacity for her to use any carry forward amounts, unused carry forward amount into the future. But she at least gets that 1 year where in this instance she sold the investment property and would have otherwise a tax liability on that. She would then be able to claim the larger tax deduction. So utilising not only the gap between what our employer contributes and what the concessional cap is one bonus, but for those who are less than 500,000, then adding in the unused concessional is the second part of the strategy, and then utilising the ability to contribute via reserve is by bringing forward that amount from next year is clearly another strategy that self-managed superannuation funds can utilise. But let's now take this one step further, because what we can also look at here is, okay, do we have inequity between, or inequality or whatever, from a balancing point of view between the existing members of the fund, and do we have these sort of taxing arrangements that can provide a scenario like Helen's, and would contribution splitting benefit our members? Now, we talk about, and I highlighted the number one strategy forever and a day being the recontribution strategy. But the recontribution strategy can ultimately start from a spouse point of view from the moment that we can make contributions to ourselves, right, subject to our spouse meeting certain conditions. So if we've got concessional contributions going into the fund on our behalf, we can split those contributions to our spouse, subject to the spouse being under preservation age, or if they are over preservation age but less than 65, then they must still be working. So ultimately, we can use contribution splitting right through the period that we otherwise wouldn't have access to unrestricted benefits to do recontribution strategy. So clearly our first real large amount recontribution strategy is when we started TRIS, and we could do 10%, 10% out and money back in for the spouse. But in the essence of, and that's of the account balance, in the essence of actually moving money from one spouse to another, we can utilize it from the time we make concessional contributions into the fund, subject to the spouse meeting the eligibility requirements. So of course it doesn't work in this sense for non-concessional contributions, but of course if you've got that money on the outside, you can just make a standard spouse contribution there. So the key thing with contribution splitting is the split will normally occur in the year following the year that the contribution is made. So if we do make a contribution in the 24-25 year, then the application to split would come in the following year, and the amount would be processed at that point in time, which again, from a self-managed super fund point of view, is ultimately a journal entry, right? And you know, we talk or we talk in whispered tones when we're talking about journal entries in super, but the contribution splitting is actually a genuine arrangement where the money is not actually moving funds, and so it's really just moving interest from one spouse to the other. So we have to prepare all the necessary documents, then we would do that or undertake it in the new financial year. The one time that contribution splitting would occur in the year that the contribution is made is if the contributor is moving into pension, and so therefore those contributions would be captured under the commencement of that pension. Then you can make an application to do the split prior to the pension commencing. And we'll touch on that briefly in a moment. So what's important to understand is what the maximum amount is from a contribution splitting point of view. And the maximum amount is the lesser of 85% of the concessional contributions for that financial year, and the concessional contribution cap for that financial year. So what that of course means is that when we then factor that together with our catch-up carry forward unused amounts, right, it actually is going to for those people with a total super balance of less than $500,000, it's going to increase the amount that we can actually split from one member to the other. So if we sort of take Helen's situation a little bit further, so we know all of the information from the previous carry forward and reserving slide, where we've made the personal deductible contributions of 118,500 because we brought forward some from next year, and we've got our employer contributions of 11,500, means our total concessional contributions for the year are $130,000. Now, Jack, who is self-employed, Helen's husband, has a smaller balance, and this is not uncommon to see self-employed people who are putting a lot of their money into their businesses. They don't necessarily have the proceeds in super, so he does have a lower balance. But we can split the contributions after the 30th of June of 2025. Now, of course, Helen is 60, so if she started a TRIS, and I'll touch on that shortly, if she started a TRIS, then maybe we would do it in the 24-25 year. But in this instance, we're going to do it in the 25-26. So Helen could actually do a splitting application, and she could indicate that she wishes to split up to $110,500 of those splittable contributions, right? Now, this is because she had the 500,000, but also because what we have to do is we have to take the lesser of 85% of the concessional contributions, or the cap for the year, and her cap for the year is $112,000. So when we do our numbers, 85% of 130,000 is 110,500, and her cap is 112, meaning that we can actually do a split of that 110,500 from Helen to Jack, right? So what we would do in the new year is once the accounts are finished, we would do the transfer from a rollover, an internal rollover of 110,500 to Jack. Helen would have to lodge her notice of intent to claim a deduction for 118,500. Helen would need to lodge a request to adjust her concessional contributions with the ATO for $18,000, and then Jack or Helen would need to do the application for the splitting for the $110,500. So when we put these contribution strategies together, we can see that, one, we can save a lot of tax personally through the use of the carry forward concessional contribution in Helen's instance there, but we can also use contribution splitting in this instance to go a long way towards rebalancing the amount in the account for Jack. But let's take that one step further. Now, we know that Helen's utilised her full carry forward amount in this year, but by taking that $110,000 out of her account, right, which is effectively the contribution less the tax there, right, her balance is going to be there and about that $500,000. So she still could conceivably, if she didn't utilize the full carry forward amount, still have access to carrying forward that amount in the following year. So there's ultimately other benefits that can be associated with that whole contribution splitting strategy as well. Now, I just wanted to sort of move away from the personal deductible one for a moment and talk about the tax cuts that came into effect from last year and how they might affect these strategies from a superannuation fund point of view. Now, what we know is that from 1 July, it took us back to 16% for that $18,000 to $45,000 mark there. So it gives us a real opportunity to look at lowering our overall tax rate for individuals, and particularly with the onset of a TRIS, given that preservation age is also now 60 years of age. So one of the key things that I would highlight there clearly, and this is just referencing Helen's contributions over the journey up to 23-24, right? Because we're going to look at the 24-25 year as part of this calculation, knowing that once we get into 24-25, we can't look at the 2018-2019 year. But if Helen was to say, okay, well, we're not doing that whole sale, the whole property sale, or we might, and we might come back and contemplate that in a moment from a tax point of view. But Helen could also say, okay, well, I'm currently earning $100,000 in super. $100,000 income. I'm currently getting my super guarantee contributions made, and I'm paying marginal tax on my $100,000. And that marginal tax rate, right, excluding Medicare and not factoring in other deductions or anything else, she's paying $20,788, right? So her take-home pay is just under $80,000. We know that she's got a higher contribution cap. The super guarantee amount is $11,500. Tax on that $11,500 is $1,725, giving a combined tax amount of $22,513. Take home pay of $79, closing super balance of $429 roughly. Sort of, actually that number's probably a little bit higher. But you get the sort of the drift there, because I actually started this on about $420, the example. Employment income, $45,000, and then she actually enters into a salary sacrifice arrangement, right? So now her employment income has a personal tax liability of $4,200, dropping her take-home pay down to $40,000. Contribution cap's higher there. Super guarantee, and I'll correct those numbers in the final version that I sent through to you. The super guarantee 11.5, salary sacrifice $55,000. We know that she's got that extra cap space. So the tax on super is roughly $10,000, combined tax of $14,000. So saving tax across both entities of $8,200. Taking from a tris, $42,000, right, because that sits within our minimum maximum range there. Gives us take-home pay, and that's all non-assessable income, take-home pay of $82,000 and a closing super balance of $434. So in this instance, what we're actually seeing is more money in her pocket personally, more money in the super fund, and less tax overall. So incorporating salary sacrifice for people over the age of 60 is certainly going to be an opportunity that should be investigated for our clients. Now, if I take a different position with Helen, and we look at the fact that she's looking to sell that investment property and has owned it for over 10 years, and she lived in it prior to her and Jack purchasing and moving into a new family home 8 years ago. So that property is going to be subject to CGT, but it will also qualify Helen to make a downsizer, because she's going to get the partial main residence exemption on that property. So we could actually be looking from Helen's point of view at the capacity to say, okay, well, in addition to trying to offset, and we don't know, like, let's assume the proceeds are significant enough to warrant this, but Helen could actually, one, make that deductible contribution, like to offset the capital gains tax liability on the property, so she could make the personal deductible contribution. But she could also then, because the property would qualify for a downsizer contribution, she could also utilize that $300,000 downsizer amount to enhance her balance. Now, of course, we know that that's going to knock her out from any carry forward catch up in the future, even if she went through the whole splitting process, all that sort of stuff. By making the downsizer contribution, she wouldn't be able to avail herself to that. But if she didn't utilize the full carry forward amount, then, you know, the downsizer piece, she could potentially utilize the requirements of, you know, you have to make the contribution within 90 days of settlement. Like, if settlement was late in the financial year, that 90 days could trigger her into the next year. So she might be able to, in certain instances, make the contribution, but also get have the downsize made into the next year. And if her balance is still below 500, subject to whichever other strategies we tend to use there, get the unused concessional amounts utilized in the 25-26 year. So that's one of the options available to her. And of course, you could also make a contribution for Jack in those instances. But of course, noting that her and Jack have also purchased a home, say 8 years ago here, then she could be a downsizer, but it also can be non-concessional, right? So there's nothing to suggest that that we should use the downsizer when we sell our property between, say, 55 and 65, when if we then purchase another property, we could avail ourselves to the downsizer at a later point in time. And so we can use downsizer effectively as a top-up strategy right, once we've started utilising our superannuation from a retirement phase point of view, sort of through our 60s and 70s, then potentially downsizer can be an opportunity later where we've got total super balance space or general transfer balance cap space to be able to make non-concessionals early. So the beauty of being in Helen's situation is that she actually got the capacity to make a decision as to whether or not she will make downsizer contributions or she will make non-concessional contributions, and similarly downsizer for Jack, who's 59, or non-concessional spouse contributions for Jack, who's 59 as well. So, you know, there is that beauty with the downsizer dropping back to 55. A lot of us, and I certainly was leading the forces here, leading the charges here. A lot of us sort of question why it was available for, or changed down to 55, other than being an election promise at the last election. You know, what was the point? Well, the point, one of the main points now is that we've got choice and we've got options to determine whether something should be downsizer or non-concessional in those pre-retirement years, where we're more likely to have less than that 1.9 million / 2 million from a total super balance point of view. So really what I've been trying to identify with reference to utilising both the carry forward concessional contributions, but not only the carry forward concessional contributions, the use of reserves, the use of contribution splitting, but then aligning things with things such as or downsizer as well, but then also contemplating the flip side of rather than making personal deductible, rather making salary sacrifice contributions, because by making salary sacrifice, you're effectively saving it. One of the beauties of the salary sacrifice from a self-managed super fund that I didn't necessarily highlight before is ultimately just the timing of tax as well. Because if you receive that money from a PAYG point of view, then your employer is remitting that tax to the ATO. You're not seeing that money. Whereas if the amount has been contributed to super as it goes along, then yes, there is a liability on the concessional contribution, but that liability is actually pushed out until the fund lodges its return. So, you know, you're not in effect paying the marginal tax rate or the 15% tax rate or whatever. You're paying the effective fund tax rate when you come to lodging the return. So there is certainly a benefit in capacity of, say, making a salary sacrifice contribution versus doing it as a personal deductible contribution at the end of the year. And that's something that obviously people need to take into consideration. So we identify a number of those key strategies, and we say there's lots of opportunities for us there without looking at the basic recontribution scenarios and non-concessionals as we go along. There are multiple opportunities for us there, but what happens if we get it wrong? And I think this is the one thing that the rules used to be more accommodating, but the tax used to be worse, so the outcome used to be worse. So the rules around certain refunds were certainly more accommodating pre-2017. However, the excess contribution requirements and excess contribution tax liabilities and excess charges and things like that were far worse, and clearly they were ridiculous in the early days, where people could be up for that 90% tax. Which, I mean, to be fair, if you want to, if you still want to opt into the old style non-concessional contribution tax rates, you can. It would be the stupidest choice that an individual would make, and clearly it would be an unadvised decision. So anyone who has anybody advising them on tax is going to tell them from a non-concessional point of view to withdraw the excess non-concessional contribution and just pay tax on the associated earnings rather than pay 47% tax. So what we need to appreciate is, going through some of the numbers that went before, our contributions are subject to the cap. So our concessional cap of 30,000 or the carry forward amounts if we've got less than total super balance of 500. And our non-concessional cap is measured against our general transfer balance cap and our total super balance. So a non-concessional cap is not it is effectively a moving beast. It's nil if we're currently above that 1.9, and then we move up into those fractional amounts, 120, 240, 360 over 1, 2, and 3 years, subject to the diminishing value or the growing value of our total superannuation balance. So, of course, that's the cap, and all the cap means is which amounts are subject to a tax concession. It doesn't come back to the acceptance pieces, because acceptance requirements under SIS are purely age-based. There's got nothing to do with balances. It's got nothing to do with work requirements or anything else. It's exclusively to do with your age. So we're not needing to determine whether you exceeded the cap. We're not needing to determine if you met the work test. The money just comes in. So therefore, it's easier now to exceed the cap, right? Now that can be done via a deliberate action, right? So deliberately exceeding the cap, and sometimes that's come. I've seen presentations over the years where people have advised people to exceed the cap, but to keep money in the superannuation environment longer and then pay the tax at the end. Not a strategy that I've ever wanted to recommend, but I've certainly seen it done. But then there's also inadvertent errors, right? But in addition to inadvertent errors like timing errors, there's also failure to lodge the appropriate elections. And both that failure to lodge and the inadvertent error generally provides very little recourse from an SMSF membership point of view and trustee point of view with the ATO. And every case that I've sort of studied in depth where the client has basically said, I've made a mistake, or that I got advice from my advisor, or I got advice from my accountant, or I went on to this website for the super fund, or I did all these other things, generally the tax office don't accept any of those reasons as acceptable for a genuine mistake to be rectified in super, which means that most of our contributions are going to ultimately end up being excess or non-concessional contribution. And probably nothing highlights that more than personal deductible contributions, is that we put a contribution into the super fund under the assumption that we're going to claim a tax deduction, and then we don't get that tax deduction because either we have commenced a pension and we haven't lodged our notice prior to it, or we're not valid because we haven't met the work test after age 67, then those amounts cannot be returned because they're always going to be accepted under the personal contribution requirements pre-age 75. But what they're going to do is they're going to count towards our non-concessional contribution cap. Now, if they count towards a non-concessional cap, that could be okay. There might not be a problem. But if it results in an excess, again, it's going to mean we move down the path of having the excess non-concessional amount refunded, an associated earnings amount being calculated, and paying tax on that with a 15% rebate. But of course, it could trigger our bring forward at the wrong time, which can then be problematic if we've then in the next year utilised our bring forward. So it can just extend and create a bigger problem for us when we get these sorts of things wrong. So, understanding the excess contribution rules and how they work is pretty important. Understanding that there's only really a refund mechanism post age 75 if you make a contribution that was personal and you don't satisfy the downsizer requirements. But there are other contribution traps. In addition to the deductibility, as I said before, that CGT notice that I've seen, that can happen with personal injury and the timing, not getting in on the appropriate time. Miscalculating of total super balance for carry forward concessionals and bring forward can be problematic there. But more recently, things like the NALI rules and the in-specie contribution requirements can be problematic. But knowing that any transfers that people do from overseas are going to be subject potentially to foreign exchange rates, and making planning based on one rate and the money coming in another rate, where those amounts will count towards your non-concessional cap, can be problematic. So look, to finish things off, ultimately there's a couple of key areas that we need to, so I just put as a bit of a trigger reminder there. In-specie contribution rules in light of the update to LCR 2021-2 and TR 2010-1, where with regards to the non-arm's length expenditure and doing off-market transfers, just be careful there. But also understanding what other circumstances might lead to a contribution being made. So paying expenses on behalf of the fund, forgiving debts, etc., can be treated as contributions. So lots of opportunities still available to us up to and beyond age 75. It's great to understand, have an appreciation for how those various strategies interact. And a part of that is working out whether or not it's appropriate to rebalance between spouses or not. But a lot of it will come down to understanding the rules around those contributions and ensuring that you make the appropriate elections, you make timely elections, and knowing that if you get all that wrong, that there's going to be limited capacity to refund the contribution. And of course, as I highlighted through this, we've also got to factor in future policy changes, and those future policy changes are likely to impact future contribution rules. And nothing says that more to me than the fact that since 2017, if you're factoring in indexation, which is a change to superannuation issues, there's been over 30 changes to both factors, numbers, rules, acceptance rules since that date. And so that's just a small mirror of a small window into the super industry. So to suggest that there won't be changes in the future is probably a little naive of us to do. So thank you very much for attending and I've actually got these two around the wrong order, so I apologise for that. On the 22nd of May, we're doing an end of financial year checklist. And then on in June, I'll be doing a legacy pension and reserve SMSF webinar on behalf of SuperGuardian. So thank you for attending. As always, you'll get sent a copy of the presentations. I'll make an update to those slides, and you'll get a copy of the slides and your CPD through SuperGuardian. So thank you very much, and I look forward to seeing you all in May.